In the United States, the average household carries tens of thousands of dollars in debt. Credit cards, student loans, car payments. But here's the uncomfortable question. What if this isn't happening by accident? What if the system actually works better when you stay in debt? Most people think debt is simply the result of bad financial decisions. Spend too much, borrow too much, pay the consequences. But modern economies are built on something very specific: consumption. And consumption works best when people can spend more money than they currently have. That's where debt enters the picture. Credit doesn't just help people buy things, it helps the entire economy keep moving. Mechanism 1: credit cards. Let's start with credit cards. Every time you swipe a card, several companies make money. Payment networks like Visa, Mastercard process the transaction. Banks issue the credit, and if you carry a balance, they collect interest. Credit card interest rates are often extremely high, sometimes 20% or more. And minimum payments are structured in a very specific way. They're designed to keep your payment low enough to feel manageable, but high enough to keep the interest flowing. That means a relatively small purchase can take years to fully pay off. Mechanism 2: buy now, pay later. But the system has evolved. Instead of simply encouraging credit cards, companies are now pushing something called buy now, pay later. Platforms like Affirm let consumers split purchases into smaller installments. At first glance, it feels harmless. 4 payments instead of 1. But psychologically, something important happens. The price feels smaller, more manageable, which means people are more likely to spend more than they originally planned. And when millions of consumers do that, total household debt climbs even higher. Mechanism 3: student loans. Then there's one of the largest sources of debt in the United States: student loans. Higher education has become increasingly expensive, but instead of lowering prices, the system made borrowing easier. Government-backed loans allow students to take on large amounts of debt at a very young age, often before they fully understand the long-term consequences. By the time many graduates enter the workforce, they're already starting their adult lives deep in the red. Now step back and look at the bigger picture. Debt benefits a lot of powerful institutions. Banks collect interest, retailers sell more products, financial companies process more transactions, and the economy keeps expanding. In other words, when people borrow, everyone in the system gets paid. That doesn't mean debt is always bad. Credit can help people start businesses, buy homes, or invest in education. But it does mean something important. The modern economy isn't designed primarily around saving money. It's designed around spending money. And debt is one of the main tools that makes that possible, which raises a question most people never ask. If the entire system benefits from you borrowing, how hard do you think it will be to escape it? If you like this video, please like and subscribe. Thank you.